Hello and welcome to your daily news and information update. Today's topic, bank failures on the rise. The banking system in the United States is still being overhauled in the wake of the financial collapse. Small banks, which were not recipients of TARP funding, have gone under in droves, and the FDIC is working overtime just to keep up with an escalating wave of failures. The failed bank list has seen its population for this decade more than double during 2009 alone. From 2000 to 2008, a total of 54 American banks failed. Just 7 months into 2009, the U.S. has already seen an additional 64 banks collapse. The latest wave came on July 24th when 7 firms went under in one day. 6 of them were subsidiaries of the same Georgia-based Security Bank Corporation. The rash of collapses has put a great deal of strain on the FDIC, which is obligated to back client deposits within a prescribed range. For most customers, any deposits up to $250,000 will be supported by the government if the bank fails. Despite this tumultuous financial environment, some firms see the banking disaster as an opportunity for expansion. According to a column from CNNMoney.com, some of the larger regional and international institutions are buying banks out of FDIC receivership for bargain prices. According to the FDIC's own procedural code, it must resolve any bank failures in the way least costly to the fund itself. With the fund already operating at just 1/4 of its statutory minimum, it has become a sort of deal maker between solvent and insolvent banks. The fund sells failures to other banks in a move which simultaneously removes that bank from FDIC hands and also takes the insured deposits off of FDIC accounts. Dealing with the 90 bank closings since January 2008 has already cost the FDIC $31.1 billion. Solvent firms are becoming increasingly interested in buying banks back from the FDIC because they know that the fund will always be there to support their customers. With failures escalating throughout the year, with 19 banks closing in July alone, absorbed financial firms could become an industry standard. As a result, we could see once large and diversified marketplace become completely dominated by enormous conglomerates. The days of local savings and loan or locally owned and operated banks could be behind us. These smaller firms are saddled with the same problems facing the industry giants, but they have none of the government connections and receive none of the bailout money which went to those companies deemed too big to fail. On behalf of concerned citizens, I'm Craig Harrington. For more on this and other related topics, please tune in daily to economyincrisis.org.
Wake up, America! Open up your eyes! Wake up, America! Wake up!